Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, as we wrap up 2022 and what a volatile market it has been, I want to take this time to look ahead with someone who is very well known and very well respected in the investment community. That is Dennis Gartman. He is the former editor of the Gartman letter and now also the chair of the University of Akron Endowment. Dennis, great to be with you, and thank you so much for your time. And you are such a well-known, well-respected name around the world.
Well, thank you for saying that. The check is in the mail to you for the wonderful
Oh,
endorsement. Thanks for that,
thanks.
Catherine. Very nice.
Thank you. Oh, that's sweet. Well, I have to, I was thinking about this as we were getting ready to start today, Dennis, and you don't know this, but I actually started in the investment business back in 1995 in Canada before I went to the States and Goldman and then TV. And I worked for a broker as an assistant. And my job every morning back in 1995, we got your letter. He was a subscriber to you. And my job was to fax it to some of his clients who had to read your letter by 8:30 every morning. And I'm quite sure it was a fax that we used. Do you remember those days?
I remember the days of having faxes sent out. I have a great story about sending the fax to people. One day when I sent it out via fax and put it in the fax machine to have it transmitted, I put it in upside down. And somebody called me and said, "You sent me the letter upside down." I said, "Just turn it around. It'll be fine." "No, you sent it to me upside down." I said, "Just turn it around. It'll be fine." She said, "No, you sent it to me upside down." I said, "I'll send you another copy."
Oh my goodness. And how well did that person do in investing, I wonder?
I doubt that she lasted much longer than that day, but it was hysterical. I still laugh about it. That was 30 years ago.
Okay,
We
yeah.
used to it used to be quite funny sending it out via fax, and I had several machines that we'd send it out through, have a list of who got it, who didn't get it. Finally, I had somebody that was sending it out, burst faxing it. That went on for about 3 or 4 years, and finally the internet came in, and Adobe Acrobat changed my cut my costs from almost $20,000 a month in fax charges to basically zero, which was which was a nice benefit. So it was I think I
Yeah.
was the first internet business of consequence, to be quite honest.
I remember those days. Like when I was thinking about getting together with you today, I'm like, my goodness, it was a fax we used. Like it's so hard to even believe. But anyway, it's a great story. It's been a long time, and then of course we met and connected when I was on BNN Bloomberg. So
Yes.
great to talk to you again here on the news forum. Dennis, let me just ask you in your recent note, you say we're in a bearish market and we've been in it since the beginning of
Yes.
2022, first week. Where do we go for 2023?
I think we head quietly lower, not dramatically lower. I think we head quietly lower. I think the problem that we have is that the fuel that has driven the bull market for the last 7, 8, or 9 years after 2010, actually it's 12 years basically, was the Fed adding to its balance sheet on a consistent basis, driving its assets levels from $900 billion to a stunning $9 trillion. And the Fed has said it's going to go through quantitative tightening rather than quantitative easing, which means it's going to be reducing its balance sheet by about $95 billion a month, taking the fuel away that had driven the bull market for the past several years. And when it's like taking your foot off the accelerator on your automobile, when you do, it slows down. If you take it off completely and apply the brakes, it stops. I think they're applying the brakes. I think they're slowing things down, and I think that's going to be deleterious to share prices on balance. It'll be deleterious to the economies also, but it's going to be more deleterious to equities prices. So I'm bearish of
Hmm.
stocks at this point, have been since January 5th of this year. My wife gets angry at me when I admit that I've been wrong for the past 2 months, but I've been wrong for the past 2 months, but I've been right for the past 11 and a half. So we'll see what happens.
So you've been wrong in the sense that the market's been rallying or recouping some of those losses. Obviously, we're still down on the year. But the market seems to be pricing in the fact that the Fed might not be able to continue to raise rates or tighten the balance sheet. They indicated yesterday, though, that they're going to continue on that path. So we're seeing the markets pull back. So you're right today. But we're also seeing weaker economic data as well, which would lead some. So we'll see how today ends up. We pre-tape this on Thursday. We'll see if the market believes that the Fed will actually have to pull back, which was the original reason for the rally.
I think that the market has gotten it wrong. I think the Fed intends to maintain a very tight monetary policy through the course of the next several months, probably through the course of the next several years. And if I've learned anything in the 45 years I've been in the business, once the Fed begins to change monetary policy, goes from easing to tightening or tightening to easing, it takes rates much farther and takes them for a much longer period of time than even the most radical among us believe. And I think that that's what's going on right now.
Dennis, I just want to pick up on what you just said, which is, when you have a change in monetary policy, it seems as though things continue to essentially move in that direction, perhaps longer and steeper than people believe. But, for the past decade or so, since quantitative easing, we have seen so many different movements, where you do think it was 2018, right? December of 2018, where we had a big drop in the market because of a misstep. In other words, they can continue to walk these comments back. So why would it be different this time?
I think that we have to pay attention to the fact that when the Fed began to ease several years ago, the overnight Fed funds rate to the zero bound and kept it at the zero bound for years. Nobody anticipated that. Nobody expected that. And yet that's where we went. Now we've gone from the zero bound. We've got the overnight Fed funds rate up in the fours. We're probably going to go to the fives. And I think Mr. Powell wanted to make it abundantly clear yesterday when he spoke that anybody who thinks that the Fed is going to ease monetary policy soon and cut the overnight Fed funds rate rather than increasing it is absolutely dead wrong. I think they're going to continue to fight inflation on a very severe basis. He intends to continue that policy for a long period of time. And it'll probably be 2024, maybe in the middle of 2024, before they stop raising rates and actually let rates go sideways for a period of time. So again, if I've learned anything in 45 years, it's that when the Fed changes policy, it moves rates a lot farther and takes them for a lot longer period of time than the most radical among us want to believe. And I think that's going to be the same process here. They are animals of history, and they tend to repeat themselves.
What do you think will be the implications? How do you want to set yourself up for that? And I know you've got good trading ideas for us today, but what do you think, like, even for somebody who doesn't trade or manage their own money, what do you think we need to be bracing ourselves for?
A reduction in housing prices over the course of the next year and a half or 2 years, probably a real decline in housing prices, not as substantive as we saw in 2007, 8, and 9, but nonetheless a decline of probably 5 to 10% in housing prices. I think you're going to see a continued decline in automobile prices. I think you'll end up seeing a decline eventually in most agricultural commodity prices of consequence, but that's off into the future for quite some period of time. But probably the most important thing is housing prices are going to come under pressure. You can't drive the mortgage rate from 3% to 7% without doing, I think, rather substantive damage to housing values over the next year or two.
And how concerned would you be as well about individuals who over-levered or thought, I'm going to take out a loan on this house or an extra mortgage so that I can, become a real estate owner of sorts? How much damage do you think is going to be done on the personal side?
I think if you had the chance to be a renter, you should probably try to rent for the next year or two. I think you want to avoid being an owner for the next year or two. We'll see. Time shall tell if I'm right or wrong. But
right.
Well, that I think is that's to me the driving force behind higher interest rates.
So let's dig into some of the ideas then on the back of where you see the future unfolding. What do we want to own from a tactical perspective right now? I mean, gold, you've been a gold bug. Is that still the case?
I would hesitate to call myself a gold bug because gold bugs believe in the demise of Western civilization, and I don't believe in that. There are times when you should own gold. Okay. There are times when you should not own gold. And I think this is one of those times when you need to own gold. Not dramatically, not a huge amount, but I'm, like I said, for my own account, I'm long of gold and short of the equities in equal dollar terms. And I'm comfortable with that today. We'll see what happens in the course of the next several weeks. But right now it seems to be working. And if it continues to work on a day like this, what's the case for gold? Yeah. Geopolitical circumstances prevailing. That's predominantly it. The one caveat against gold is the fact that the monetary authorities are tightening monetary policy, which should be deleterious to gold prices. But I think the geopolitics of the world are manifestly bullish of the gold market, given the right now. We'll see what happens. The fact that gold got above $1,800, I think, was impressive. And when it gave up a little bit overnight, it came under rather substantive pressure last night, falling $19 or $20 an ounce, and yet the volume had gone to nothing. So that was, to me, that's impressive. But the the bearish circumstances, the monetary authorities being as tight as they are, that's the one thing that I have to be concerned about as I'm bullish of gold. But I wouldn't call myself a gold bug. Again, there are times when you should
Okay.
own gold. There are times when you shouldn't own gold. And I think this is one of those times geopolitically that you should.
Okay. We're going to take, well, one question. What about oil before we head to break?
Watch the term structure. Watch how the front month of crude oil trades relative to the second, the third, the fourth, the fifth, the sixth month back. And I think on balance, if you ask me where crude oil is going to be in the 6 months to a year from now, I think probably quite a good deal higher, predicated upon China coming out of its shutdown. If you ask me where crude oil is going to be in the course of the next 2 days, 3 days, a week, maybe a bit lower.
Dennis, I just want to pick it up on your view of oil going long, or that you think oil price is going to be higher longer term out. Why is that?
First of all, what I mentioned in the last segment is watch the term structure. Watch how the front month trades against the deferred months. In a good bull market, the front month should gain on up days and should gain even on days when the market goes lower. The market should go to a backwardation, as it's called. And we actually went to a contango over the course of the past month and a half, which had me being bearish of crude oil. But in the past 3 or 4 or 5 days, we've watched the backwardation. We watched the contango disappear and the market go back to a modest but important backwardation. The front months are gaining on the deferreds, and I think that's important. The predicate for higher prices is China, no question about it. China's coming out of its shutdown given COVID. I think this is an important circumstance, and that's going to be the driving force. Plus the fact that the OPEC nations all seem willing to, or rather I should say unwilling to increase production and willing to decrease production on almost a steady basis. So I think that China and OPEC, 6 months from now, a year from now, 2 years from now, crude oil prices are demonstrably higher. A week from now, crude oil may be slightly lower. But the driving force is watch the term structure. It is the best leading indicator of where crude oil prices are going to go. And in the course of the past week and a half or so, the term structure has quietly, and I think importantly, turned bullish.
And just to pick it up, do you also believe, though, in Goldman's call, and also we invest with Rafi Tamazian, and he's had this call for a number of years, but there's been such supply constraints around the world from various companies, governments, et cetera. Is that not a key driver as well in your mind?
Oh, no question. We're doing stupid things here in the United States, trying our best to slow down the finding of and the drilling for and the refining of crude oil. I think our government has done a dastardly job. The way we've treated Canada has been utterly disrespectful, and I think patently stupid on our part. That'll change over time, but we shall see. So we're increasing production, but we could increase production here in the United States to 13 or 14 million barrels per day, and we don't seem to want to be able to do that. It's I think patently stupid, patently illogical, and patently wrong.
Okay. I want to get your take as well. If we're looking at equity prices going lower, what's a great way from an investment perspective to express that? And I know that you can short an index. Can you talk to us a little bit about how you go about doing that as a hedge?
The swiftest and easiest way is to be short the S&P future, but most people don't like to trade futures. I understand that. And there are ETFs predicated upon declining prices of equities prices. SDS is a double, as it's called. It does twice the beta of the daily action of the market. SDS is one way to do it. I forget the name of the 1-to-1 rate ETF, but there are ETFs that give you exposure to the downside. SDS is the one that I use more often than not. It seems to function very well. There's good liquidity. You can do any size that you want, 1,000 lots. 10,000 lots, 10,000 shares without moving the market. I think that's the place to go. So the S&P futures are the quickest and easiest way, but most people don't like to trade futures. So I understand that.
Yeah, myself as well. But my only concern about doing like a double short ETF of sorts, SDS, as you mentioned, is there's the inherent decay in it, isn't there?
Yeah.
Am I wrong?
Yeah, there is. There's inherent decay. If the S&P goes sideways and you own SDS, you're going to lose a couple cents each day. So that's the problem. You have to be very right in order to make it work. But when you are right, it works. But you're right about the decay.
Okay.
That's something to be concerned about. Very good. Thank you for bringing that up.
Okay. Well, only because I've wanted to do this and I haven't done it because, to your point, I don't want to trade futures. But Dennis, before we get to your rules of trading, which I really want to get to for investors today, a couple stocks that you do like. You are owning a couple of stocks. Which ones are they?
The only ones that I own Altria, ticker symbol MO, because it's got a well-covered dividend and it seems to have formed a nice bottom. I like the fact that it doesn't make new lows. It goes up on better volume. And I own a bit of Verizon, basically predicated upon the fact that it also pays a well-covered dividend. And today it's breaking out to the upside, even on a day when the market is down substantively. Verizon's trading higher, which is impressive. So I may buy some more before the close.
Okay. Let's get to a couple of your rules of trading. What's number one on the list?
Number one it's always number one. Never add to a losing trade. If you buy a stock at 15 and it goes to 10, you're wrong. The market's telling you, why should you do something that's wrong? If you buy a stock at 15 and it goes to, you're right. The market's telling you that you're right. And the only thing that because your equity value of your account has gone up in size. So always buy more of that which is going up, do more of that which is working, try to do less of that which is not. That's a good rule in life, and it's a great rule in trading. That's rule number one.
What's another top rule we should be cognizant of?
There's never just one cockroach. A very simple rule, but whenever bad news hits, there's almost always more bad news to come along. When a CEO resigns his position, or when a CIO resigns his position and says he's leaving or she's leaving to spend more time with the family, almost always, it means there's bad news coming. So it's a simple rule. It's a fun rule. There's never just one cockroach. There's always more bad news to follow. One of my other favorite rules is if you be bullish when things are going from the lower left to the upper right, when you understand some of the simple fundamentals and you understand some of the simple technicals, bullishly. When things are moving from the upper left to the lower right, and as you understand the fundamentals in simplistic terms, some simple, easy to understand fundamentals that are bearish and the technicals are bearish, bearishly. Keep things simple as you can. Complexity builds confusion. Simplicity, I think, builds profits. So those are my favorite rules of trading.
Okay. I'm curious as well, what do you think about tax loss selling, right? Obviously, the idea that you've got some weak players in your portfolio, it sounds as though you get rid of weakness very quickly. And some of the biggest hedge funds in the world do as well. I mean, if you're going to be down 10%, you get out of that position ASAP, right? What are your rules surrounding when you get out, but also the idea behind tax loss selling? I don't like to sell just because of taxes if I think they're a winning trade on a fundamental basis. What do you say to that?
I usually say that anything that goes against me by more than 7% probably tells me I should at least be reducing the size of the position. And if it goes against me by 10%, I probably should be reducing it completely. As far as taxes are concerned, I pay very little attention to taxes, whether it's short-term or long-term. Taking positions adjusted because of tax considerations, I think, is illogical and ill-advised. Take positions because you understand fundamentally why something's going up and it's going up. Take positions because something is fundamentally going down and you understand the fundamentals and it's going down. But taking positions predicated upon taxes, I leave that to tax attorneys. It's beyond my ken.
Okay. I'm glad to hear that because I feel the same way. And yet people always say, well, it's tax loss selling season. I'm like, so what does it change for me in terms of, so what, right? I don't know. Let me ask you this one as well with respect to trade like a mercenary. What does that mean?
You want to be on the side of the team that's winning. That's really quite that simple. You don't want to be patriotic. You want to be a mercenary. If the Bulls are winning, be bullish. If the Bears are winning, be bearish. Trade like a mercenary, not like a patriot.
Okay. Lastly, Dennis, I want to get your take on what's going on in the news. I do follow crypto and blockchain closely, and I hope anybody out there listening to the news is recognizing what happened with FTX and Sam Bankman-Fried and the bankruptcy there and whether there was fraud or not. What's your take?
I don't think there's any question that there was fraud. I don't think there's any question, but that there's no question that they used customer money, which should have been segregated, put it into a trading account at Alameda, and basically traded it away. They probably added to losing trades all the way down in Bitcoin, probably traded all the way down in their own tokens. I I have had, I've been deleterious or detrimental or ambiguous about cryptocurrencies from the outset. I think there's great merit in the blockchain. I think it's going to change the manner in which we trade, the manner in which we buy or sell automobiles, the manner in which we buy or sell houses. But as far as cryptocurrencies are concerned, I've been skeptical from the day one. People made a lot of money. People have lost a lot of money. And I think over time, probably 100 years from now, we will be a cashless society with blockchain currencies that have been backed by government treasuries. Will probably be the manner in which we trade. But right now, I'm with Mr. Buffett and Mr. Munger, who believe that Bitcoin goes to $5 if it's and it may not stop there. I'll let other people trade it, and I think that this was one of the great scams of our time. It makes Enron look like a piker. It makes who was the gentleman in Florida? I just went blank for his name.
Madoff.
Madoff. Thank you. That's what happens when you get to be 72 years old. You forget names. It makes Madoff look like a small-time investor. This is a scam of the first order. The money has gone. It will not be found. It's disappeared into the ether. It was traded away and lost, and it was illegal right from the start. So I'm glad he's been arrested. I think he's going to serve a long time in jail. There are more people to follow. His girlfriend probably will follow in jail. And as I said, there's never just one cockroach.
Right. We'll leave it on that note. Dennis, great to see you. Thank you so much for all of your insights.
Catherine, great to see you. Merry Christmas and Happy New Year. Good to be back with you after all these years.
Thank you. You as well. And thanks everybody for watching.
Cheers.